Hey everyone, and welcome. Today we're going to demystify the Indian stock market. We're going to look at its daily rhythm, the schedule it keeps, the different ways people trade, and then we'll dive into a really fascinating perspective from our source material on the rules of the game. So let's get right into it.
And this quote just nails it, doesn't it? Timing is absolutely everything. It's not just about what you decide to buy or sell. It's about when you do it. Every single second can make a difference. And really, understanding the clock is the first, most crucial step to figuring this all out. So, here's our game plan for today. We'll start with the market's basic schedule. Then, we're going to slice up a trading day to see what happens when. We'll even talk about how you can place orders when the market is closed. After that, we'll get into the different kinds of traders. And finally, we'll unpack the specific rules for permissible trading as explained in our source material. Okay, first things first. Just like any shop or business, the stock market has opening and closing hours. It doesn't run 24/7, and its schedule is something every single person involved needs to know by heart.
The basic schedule is pretty straightforward. It's your standard Monday to Friday work week. Weekends are off, but there's a really cool and unique exception called Muhurt trading. These are special, usually hour-long trading sessions held in the evening on auspicious holidays like Diwali. It's a special little window for investors to make trades.
All right, so we know which days the market is open. But here's the thing. A trading day isn't just one long, chaotic free-for-all from morning till afternoon. Nope. It's actually divided into 3 very distinct sessions, and each one has its own specific job to do.
And the source material gives us a perfect analogy for this. Just think of it like running a shop. That pre-opening session, that's you getting everything ready before customers arrive. The regular session is when the doors are open and you're doing business. And that post-closing session, that's you counting the day's earnings and locking up for the night.
So this probably gets you thinking. The real trading, the nonstop buying and selling, doesn't kick off until 9:15 a.m. So what on earth is happening in those first 15 minutes? Well, it's definitely not dead time. In fact, you could argue it's one of the most important parts of the entire day. That little 15-minute window is a whole process in itself. For the first 8 minutes, the system is basically just collecting all the buy and sell orders that have been piling up. Then, for the next 4 minutes, an algorithm gets to work matching up all those buyers and sellers to figure out a fair opening price. The last 3 minutes are just a little buffer to make sure all the systems are good to go.
So why do all this? What's the point? Well, in a word, stability. This whole process is designed to prevent complete chaos. Imagine some huge news breaks overnight. Without this session, a stock could just explode upwards or crash downwards the second the market opens. This pre-opening period helps absorb that shock and establish a stable starting price.
Now, a second ago I mentioned overnight orders. And that brings up a really good question, right? If the market is shut for the night, how are people able to put in orders that are ready to go the next morning?
Well, they do that using something called an aftermarket order, or an AMO. And our source uses a fantastic analogy here. It's like telling your servant at night, hey, first thing tomorrow morning, I need you to go to the market and buy this for me. You're giving the instruction after hours, so it's ready to be acted on the moment the shop opens. That's exactly what an AMO is.
So we've covered the when of trading. Now let's switch gears a little and talk about the how. See, not everybody trades in the same style. And a lot of the time, their strategies are defined by one simple thing: time. Are they in it for a few seconds, a few days, or a few years?
When you really boil it all down, it comes down to 2 basic philosophies. You're either a day trader looking to make quick profits off tiny price changes within a single day, or you're a long-term holder, investing in what you believe is the deep-down value of a company over months or even years. Pretty much every trader fits into one of these 2 camps.
And this is where we get those specific names you've probably heard. The intraday trader or a scalper, that's your sprinter, in and out on the same day. Then you have the swing trader, who holds on for a bit longer, riding a swing in the price for a few days or weeks. And finally, you have the position trader or investor. That's your marathon runner, in it for the long haul.
Hey, and while we're talking about terms, here are 2 you will hear all the time. Our source has a really fun way to remember them. A bull market is when things are going up because a bull attacks by thrusting its horns upwards. A bear market is when things are going down because a bear attacks by swiping its paws downwards. It's a simple little visual, but it really sticks with you.
Okay, so we've got all these different strategies, all these different time frames. And this brings us right to the heart of our source materials analysis. It actually looks at these methods from a very specific ethical and religious point of view. So let's explore how it classifies these different approaches to trading. All right, For this last section, we're going to carefully walk through the conclusions that are presented in our source. Just to be clear, we are neutrally explaining the perspective and the logic that's laid out in the material, okay?
So, according to the source, the key idea, the most important distinction, is a concept called Kabza, which means true settled ownership. The logic goes like this. In intraday trading, you buy and sell so fast that the shares never actually settle in your account. That process takes about a day. The source argues this is like selling something you don't truly own yet, which makes it impermissible. On the other hand, with longer-term trading, you hold the shares until they are fully yours, which is considered permissible.
The source then looks at another common tool, the margin trading facility, or MTF. This is basically when your broker lends you money so you can buy more shares than you could afford on your own. The source identifies this as an interest-based loan using the term SUD, and because of that interest component, it classifies using an MTF as impermissible.
So, this table pulls it all together and gives us a really clean summary of the source's rulings. Intraday trading is seen as impermissible because you don't have true ownership. Margin trading is impermissible because it involves interest, and that leaves swing trading and long-term investing, where you use your own money and you wait for full ownership, as the permissible methods.
Now, the source makes one final, really subtle point. What if you buy a stock intending to hold it, but for some reason you end up selling it on the very same day? The source explains that technically the ruling, or the fatwa, actually permits this, but then it adds another layer, the idea of Taqua, or piety, and advises that it is better and more righteous to wait until that ownership is fully confirmed before you sell.
So, we've covered the clockwork of the market, the different types of players, and a specific ethical framework for engagement from our source. You know, understanding these rules is always the foundation. The real question is, what's your next step? Thanks for joining us for this explainer.